As returns, once attractive spaces in the bond level out, we should say, what should fixed income investors be buying? Well, Tim Anderson joins us now. He is the Chief Fixed Income Officer at Riverfront Investments, and he is joining us right now from Richmond, Virginia. Tim, very glad to have you with us. Thanks for joining us here on this Friday.
Thanks,
I want to
Deirdre.
know, first and foremost, what message you think the bond market is sending, a flare, if you like, it's sending up about the possibility of bubbles. I mean, and I'm just going to go through the reference, right? We have a lot of them. I mean, gold at record highs, junk debt returned something like over 60%, stocks are up. What is the bond market saying?
Well, I think what the bond market is saying is that the Fed has the power and has done exactly what they wanted to do. They've re-liquefied the capital markets. By keeping interest rates, near 0% on the short end. They've forced investors out of money market funds. We had over $200 billion flow out of money market funds in the second quarter this year. We've probably been averaging around $20 billion a week coming out of money market funds, taking more risks, going out further on the risk spectrum, either taking longer-term maturity risk or taking credit risk, and that's been reflected in a reduction in risk premiums. But we had risk premiums coming off absolute record levels. And if you look at where they are now in the corporate bond market, a little over 200 basis points over treasuries, I wouldn't say that we have a bubble in the corporate bond market. You look at high yield bonds at about 750 basis points over treasuries. Again, that's probably appropriate for where we are, at the beginning of the recovery of an economic cycle, at a point in the cycle where default rates are probably close to their peak and likely to start improving. So I really don't see signs of bubbles in the U.S. bond market. I think where people are reflecting, again, you said gold. I think we're probably more likely to see bubbles come up in China and some of the other emerging markets.
So let's talk about it. I just referenced this allusion to junk debt, but corporate bonds, investment grade, also high yield, obviously, rallying too much this year. I mean, are they going to sell off?
Well, I don't think necessarily they need to sell off at this point. I think they're priced appropriately for where we are in the economic cycle, but I think you're certainly going to see returns level off. One of the premises that we follow on the investment front at Riverfront is don't fight the Fed. And right now, the Fed is your friend. They continue to buy mortgage-backed securities. They continue to keep interest rates at 0%. So the market's doing exactly what the Fed wants it to do, and investors have been rewarded for doing what the Fed wants. Our concern probably comes, later next year, going into 2011, when the Fed, starts to pull back and begins to tighten policy.
Tim, Charles Collins, Deputy Director of Research at the IMF, International Monetary Fund, says, quote, and I'm quoting here, China needs to shift its policies on the yuan value. He is a Treasury nominee to be Assistant Secretary of International Affairs. What do you make of these comments? I mean, we keep talking about the yuan to dollar peg. I mean, what's the most likely scenario?
Well, I think at some point in time, our Chief Investment Officer has written about this in the past. We do see a resumption of the crawling peg on the yuan. We think, again, that's probably where the biggest imbalance is on a global basis. That's probably the one hope for the U.S. economy. People talk about the new normal U-shaped recovery. We think the swing factor in all this will be exports, and that'll definitely be driven by what China decides to do with the currency.
So what do you think then? Let's talk about maybe carry trade. Where's the best part right now?
Again, there's probably, at least within the fixed income markets, if we kind of bring it back into the U.S., we do like high-quality dividend-paying stocks, and within our own portfolios, we've taken money out of fixed income and put it there. For people that don't have that kind of risk tolerance or don't have it in their investment mandate, we think there are still pockets of opportunity in the U.S. bond market. Crossover debt, rated investment grade on one side, junk on the other. You can pick up an incremental yield there, probably around 5.5%. If you go into bank loan funds, these are funds that invest in bank loans, floating rate loans. You can get 4 to 6% in those. They actually benefit when rates rise, which we think is going to be happening probably over the next year to year and a half. High yield bonds, again, priced where they are. We think there's some opportunities there still. It's going to be much more halting and grinding progress than we've seen in the past. But if you can earn your coupon in that market and get an 8% type return, we think that's going to be pretty attractive in a low return environment.
Tim,
and then
sorry, go ahead.
No, then also convertible bonds. We think, again, for people that don't have the risk tolerance to go all the way into equities, you get a component of equities mixed with a component of bonds, which should give you more downside protection, but also less upside.
Tim, we thank you so much. Wish you a good weekend. Tim Anderson, Chief Fixed Income Officer from Riverfront Investments.